start recording at this point. As I mentioned, I'm not sure if he was able to join us yet in the room. I don't think he is, but I'm going to handle his questions essentially right now. I had a question come in via email. A couple of questions from Mark. Mark wants to focus on calendar spreads. He says, generally in a sideways market, what are some of the ranges in time for consideration? So calendar spread is when I'm looking to sell a near-term option and buying an option that's farther out in time. There are different structures and different ways to do a calendar spread. By definition, a calendar spread is just any form of a spread strategy using the two same options where you're selling one or buying one near term and buying one or selling one farther out in time. So naturally, with all the different expirations that we have, what should we look for days to expiration on the short and days to expire on the long? What are the benefits and what are the dangers and cautions for adjusting? Now, Mark mentioned a sideways market in calendars, so I think what he's referring to here is what's called horizontal spreads. We'll get to that in just a moment. The subtopic Mark followed up with is diagonal calendars. Why would one consider it? Again, what are the ranges in time to consider? Because we have all these expirations to look for. What are the benefits of a diagonal and the cautions and dangers, difficulties in adjusting? First, I answered Mark via email, and I told him that, I greatly appreciate the questions, and I want to handle the questions as they come in, and I'll handle any question that comes in. But this is really a full webinar. The topics he's asking about, comparing a diagonal to a horizontal, what time frames to consider, what are the benefits, what adjustments might be used, what are the problems with adjusting, that is a full webinar. We're going to touch briefly on this, and we're going to review it, but I'm going to show everyone where you can get more information on these going forward. But first, again, the definition of a calendar, as I mentioned, any combination of using two calls or two puts, or sometimes two calls and two puts, what's called a double diagonal or a double calendar, where you're selling one typically near term and you're buying one further out in time. Now, a horizontal spread, or what some people just refer to as a calendar, but really it's a horizontal calendar, is when the options have the same strike. We have a stock trading at 49.80. I sell a May 25th, next week, 50 strike call, and I buy maybe a June or a July 50 strike call. Same strike, different time periods, sell near, buy far, commonly referred to as a horizontal. A diagonal is when the strikes are different. And many people use this term, which if you've heard me the last couple of weeks when we've talked about calendars, I don't approve of it, but they talk about it as a poor man's covered call. Instead of buying a stock at 49.80 and selling a 50 call, I'm going to buy maybe an August or September 45 call that's in the money, trying to use leverage to mimic stock ownership and sell the near-term call against it as I would the stock. That's typically a diagonal, an in-the-money diagonal. You can also do it out of the money, but that takes on more risk leverage-wise, not monetarily. And we're going to take a look at all three. Okay, so those are the standard definitions we talk about. A calendar is any form of a spread. We're using calls or puts, and they're different expirations. A horizontal is the same strike. A diagonal is different strikes. Okay. Now, let's navigate over to the Power Options suite of tools very quickly here. Let me change our screen over. Fantastic. We're looking at the Power Options tools now, and essentially what we're seeing is the 14-day free trial. Those of you just getting started on your 14-day free trial, I encourage you to take advantage of the 4 steps that are listed. Accessing the quick start guide, taking a look at the free flash tutorial, the variety of free webinars archived and live, and trial and subscribers can schedule a coaching session, which is a one-on-one session with myself or Ernie. In my response to Mark regarding the calendar spreads, before I answered each little one with a 2 or 3 sentence description, I mentioned that we already have webinars that cover a lot of the topics. Anytime you can go to our free webinars tab. I'm going to send everyone this URL in the chat link. It's www www.poweropt.com/webinars.asp. Okay, make sure it's typed right. There it is. So I'll just send that to everyone. This is a free page. It's a public page. You don't need to have a trial or a subscription to access. On our webinars page, you have various topics we can look at. The Power Options tools, series of webinars getting familiar with the different tools, researching and analyzing, getting started with a search tool, and more. Under the Options Strategy section, we have a variety of presentations devoted to managing spreads, how to be successful with spreads, talking about vertical spread positions. But we also have a full presentation on the calendar spread basics, defining horizontals versus diagonals, proper structure, specific terms for the strategy, what to look out for, what to avoid, goals and expectations for the horizontal or for the diagonal. And after that, there's a full presentation on calendar spread criteria, underlying stock criteria one might use for a diagonal or horizontal. They are different. It's a different structure. You almost want to look for something different. We'll take a look at that in a moment. Criteria to set up the proper structure in a weekly or monthly diagonal or horizontal spread. So if you're interested in spreads, diagonals, horizontals, or if you're interested in the verticals, if you get the time this weekend, stop by our webinars page. Now, for those of you who might be curious, let me just go to the calendar calls here, and I'm going to go right into the search. We start off with some default criteria for you to use as a stepping stone to create your own personal screen. Okay, and I want to look for a higher price stock. Nothing's really appearing here. This is the initial value screen. Let me try this calendar leaps number 1. If not, I'm just going to go right to the custom spread tool and we'll build some on the fly. Celgene is a pretty good one, like the price there. Lowe's is good also, but I'm going to stick with Celgene for now. And let's just go to our profit and loss chart from the search tool. I could tweak the criteria, but I'm not going to bother, okay, at this point. All right. What we're looking at here is what we would consider a diagonal. Closer in time than what I would ever look for, but it came up as a screen, but it's closer in time. We'll talk about that in a moment. But with the stock at 78.45, you see we're selling an out-of-the-money 85 call for June 15th, and we're buying a June 75. Although this came up in the default search, this for me is right out. Okay, I wouldn't trade this, and I'll explain why in a moment, based on my rules. But this is kind of the profit and loss chart that you get when you trade a diagonal spread. The peak profit and loss chart occurs if the stock is trading right at the short option strike price at short option expiration. You give back some of the profit if it goes above that. We'll talk about that in a moment. And we're sort of trying to mimic stock ownership with leverage. Instead of buying stock at 78.45, I'm buying a 75 call and only paying $12.95. So for one contract, it's $1,295, and I'm still selling a near-term call against it. Let's change our expirations and our structure. I'm going to keep with a diagonal, but I'm going to go out to May 25th, 7 days away. Let's look at just at the money 79 call. Now, if I'm structuring a horizontal or a diagonal, the first rule of thumb you'll learn, or you can see in that full webinar, is I want the option that I'm buying to give me at least 4 right cycles. Okay? What does that mean? If I'm planning on selling weeklies every 5 to 7 days or every 5 days against the option I'm buying, I want this to be at least 21 to 28 days out in time, possibly 35. So I have the opportunity to roll, adjust, or at least sell against this option that I bought 4 times. You don't have to use weeklies. In fact, based on the conversations we've had in the past on vertical spreads and how our default weekly searches for bull put credits and bear call credits, we here at Power Options look at least to the 2-week out time period, 10 to 14 days, because we found over time you get a better premium going 2 weeks out long term. And when you have a loss, if you're just selling every 5 days out with a standard weekly, just a 1 week out, you receive a smaller premium. Well, when you do take a loss, it might wipe out 15 to 20 trades. But if I'm selling 2 weeks out and getting a higher premium, and I suffer a 40 or 50% loss on a spread or a calendar, I might only wipe out 7 to 10 trades. You will take losses in any strategy. That's inevitable. That's where the management comes in. But with that in mind, when I look to build a weekly, quote-unquote, diagonal or horizontal, I want to sell 14 days out, which means, since I'm going 2 weeks out, I typically want the long option I'm buying to be at least 8 to 10 weeks out, maybe in the 63-day time period. And if you're looking to trade diagonal spreads to mimic a covered call because you want to use leverage, you're going with an in-the-money call that's at least 5 months out in time or more, and then you're probably selling every 14 or 20 days against it. Okay? That's quick definition of the structures. But let's take this idea. Rhajiv made a comment, or he wrote in a moment ago. Rhajiv made a comment last week or the week before, and it was regarding a position he had where he had sold, I believe it was a 1 week out position on Disney, and he had bought 2 to 3 weeks out. That's not a structure I usually look for. I want at least 4 right cycles in case the spread doesn't go as I want. Okay? Well, that's Rhajiv's position. It leads to a very high potential return, but I would never sell this week and buy the next week out. I want more time on my side. I want to see less decay in the first 5 to 10 days, so I want to go further out in time, and I look for those 4 right cycles. So we're going 1 week out, and we're selling the 79. Mark just came in. Mark, so we're handling your questions here. We've defined the different spreads. If I was doing a horizontal, a same strike spread on Oracle, I'm going to sell the at-the-money 79 call, the stock at 78.45, and I would look 4 weeks out minimum. I'd go to June 15th, 28 days away, so that I have 4 right cycles. And this time period, the June 15th, counts as a right cycle. I can convert a calendar to a vertical spread at the same expiration if I'm still in the trade and still want to milk some of the premium out or need to adjust it because it went against me. But again, as I mentioned, we'd be buying the same strike. Here's where it gets tricky. In this case, the June 15th hasn't converted over to the weekly strikes yet. It will when it gets about 3 weeks away. So there isn't a 79 to do a vertical spread, or horizontal, my apologies. So let's crop this out here. Let's just stick with the 80. Okay, so we'll sell the 80 1 week out for next expiration, 68 to 70 cents, and I'll buy the 80. Now, this would be constructing a horizontal spread on Oracle. Weekly, keeping the 4 right cycles minimum, in my opinion, that's how I look at it. We have a debit of $1.30, same strike. But you can kind of see here why I don't like these positions. I don't trade horizontals. Even in a sideways market, I don't typically like these as a trade. Why? Well, a horizontal always gives you 2 ways to lose. Number 2, you have a very tight upper and lower break even. It is a potential in the first cycle for a 9% return in a 5-day trade, which is phenomenal. But in order for that to happen, you've got a 50-cent window here, 79.77 to 80.26, not to make the maximum profit, which occurs if and only if the stock's trading right at 80. Okay, so it's a slim upper and lower break even. 2 ways to lose small premium. Now you say, well, you could get a better premium, as you mentioned, Mike, if you went 2 weeks out, if you went to the June 1st. Yes, but then I'm going also out towards July because I want that minimum 4 right cycles. Horizontals give you too tight, in my opinion, of a upper and lower break even. You're trying to pinpoint a price. And the friends here, everyone online, you may have heard me say before, I don't trade short straddles or really short strangles, but I don't trade short straddles, I don't trade butterflies, and I don't trade horizontals. Why? Because I'm not this good. I cannot pinpoint on a consistent basis, and by consistent I mean 65 to 70% of the time, when a stock's going to be trading within plus or minus 0.3 or 0.5% of a specific strike price. Really, I don't want it to be trading more than 20 cents above or below the strike price in the next 5 or 14 days. If you can pick stocks and based on their trend, pick a specific strike price where they're going to be trading consistently, meaning 70% of the time, plus or minus 20 cents, you'll be good at short straddles, butterflies, and horizontal spreads. And also, you probably don't need my help for trading, because I can't do that. Okay? And Mark does comment in, as we're talking about these horizontals, things of this nature, and it is a weekly, that's why we're seeing such a small return. Let's look at a horizontal with a wider time range that I'd look for, but let's go 14 days out. And again, I'm going to go to that 60-day time frame as well for the July 20. So I can try to get those 4 right cycles. They don't compound because more weeklies will come. But I want to be able to write 2 or 3 times a month if I'm going 14 days out. Okay? But we'll use the 80 call now at 320, 325. And again, I'm going to sell the 14-day out 80 call about 103. Okay? So we're going to have a higher cost basis in this case. We're going to sell the June for about $1. We're going to have about $1 debit into the position, always done a debit, but we get this better upper and lower break even. $6 difference, about $1.50 down, about $2, $3 up from where we are. Still could be about a 61.3% return on our cost basis of $217. And that's the maximum, but you've got a wider range. That's another reason why I don't like trading, especially if I was considering a horizontal, with the 1 week out. The premiums are too small. The 9% return looks fantastic, but the upper and lower break even are too tight. This is still kind of tight, but it's not too bad. And the return is good. Okay, but this is a horizontal. You still have 2 ways to lose. And Mark mentioned, where I was going with that is Mark does mention, doesn't this also mean that with a tight window with the horizontal, it'd be better to trade an ETF or something that doesn't move? That's true. Just like if you're trading a short straddle or a butterfly, the most neutral of positions, you want the most neutral of stocks. You don't want the stock to move with these type of tent or A-frame profit and loss charts. But again, with the lower volatility, because they move much less, you won't see this type of return. You'll be looking at a lower return because you're going to be receiving a lower premium up front. You might be paying less as well, but this return is going to be lower because the volatility is lower. Now you have to fight to see, does it match your goals for what you're doing with this strategy? We'll take a look at that after our comparison here, Mark, very quickly. I don't want to go past maybe 5:10 at this point on the calendars here because we're just trying to wrap up. Okay? Well, not wrap up, but as we mentioned, we pointed everyone already to the other webinars that cover this in depth. All right, so if I'm looking at a short-term trade, I like Oracle, or Celgene. I'm sorry, we're on Celgene now. And this isn't a recommendation or suggestion. I'm on Celgene. I like Celgene. But I don't like this upper and lower break even. I don't like to see 2 ways to lose. I maybe want to do a covered call, but I don't want to pay $78 for the stock right now and only see a 2 or 3% return. This is where the diagonal comes in. So rather than buy the horizontal, which is one of the most neutral positions you could do along with a short straddle and an iron butterfly or butterfly trade, what I'm going to do here is I'll still go out to June because it gives me the, I'm sorry, I go out to July. Apologies, because it gives me the 4 right cycles if I'm starting with the 14 days out. But instead of buying the 80 call, I'm going to go in the money, maybe to the 70 or the 75. I'm probably going with the 70, little bit higher delta. Okay, to mimic stock ownership, I'm going to pay a higher premium. I'm not going to see that 61% return. There's still a potential for a 24% return. The lower break even is about the same as the horizontal. I can lose much more though, okay, because I'm trying to mimic stock ownership. I'm going with an in the money call, buying the 70. selling the 80, giving myself 4 right cycles, and there's a reason why I chose the 70, because it has a higher delta, and it'll gain more if the stock moves up. But I can still make a 24% return at the first cycle if the stock's trading right around 80. What's missing? The upper break even. There is no upper break even. My profit trails off a little bit from the maximum at 24% on June 1st expiration, 2 weeks away, but I don't go back into the red, and that's important. Another important factor I always discuss in diagonals, you'll see that in the further webinar, my net debit, the cost of the long option minus the premium I collect for the short, whether it's the first right cycle or second, but the net debit always has to be less than the difference in strike prices. This goes to one of your comments out of arrangement here, out of order, I'm sorry, Mark, where you'd asked about some of the things to look out for, cautions for adjusting. The first thing I always look for in a diagonal is the difference in strike prices have to be greater than the debit. Why? Because something unexpected happens next week, which would work in my favor. But if something happens where Celgene gaps up to 90 or 91 on some kind of rumor, pre-earnings or early announcement, I might get assigned early on this 80 call, which means I have to deliver shares of stock I don't own. Most brokers will go ahead and exercise the long to deliver the short, so I get $10 back. And I paid $8.56, $8.57 in. So there I'm only making a profit of about $1.42. I'm not near this full profit, but it's still a profit. There are diagonal spreads that exist where the debit is greater than the difference in strike price, and if you get assigned early, even though the stock went in the direction you want, you could be at a loss because your broker has to cover themselves, so they might exercise this long. Brings up a subtle question. How am I showing a profit of 24% if I get assigned on the first cycle and I only get $10 back? This was $8.56, so my profit's $1.42. Where is this $2.06 coming from? When you're trading any calendar, be it a diagonal or a horizontal, the return that you're seeing is based on not only the call reaching its zero value on expiration, so if the stock was trading right at 80 on 6/1, but it's based on the value of your option that you bought in the calendar, horizontal or diagonal, which includes intrinsic and remaining time because it's further out. If you exercise the option or you're forced to exercise the option, you lose the remaining time value. Okay? So at this time here, if the stock was trading at 80, Black-Scholes value of our July 70 call would be 1062. There's the profit of 205. That extra 60 cents of time value that still exists on the 70 call. Okay? And that's why you see that, because anytime you're trading a diagonal or horizontal, you want to make sure that you manage it or adjust the short call if you're worried about early assignment so that you control the ability to sell to close this call and you're not exercised by your broker in the case of early assignment. Right? Be aware of your ex-dividend dates. If your option is just at or slightly in the money, your short option, and you're around an ex-dividend date, you may get assigned early. You might want to adjust the short call at that point to avoid assignment if you want to stay in, or liquidate the position ahead of time to make sure you get the time value that remains on the long. Otherwise, you're denying yourself the time value. Okay? It's only 60 cents in this case, but you see the difference. A difference of a profit of $142 to $205. Okay? And that's important based on what your structure is. Okay, so step by step into the 3 questions Mark initially asked with calendars in a sideways market. What ranges to consider? I addressed that. I don't like to use weeklies. This the 1 week out, excuse me. I prefer to go 14 days out, and the long option, I want to make sure I have at least 4 right cycles available. If you want to do the 1 week out, that's fine. My recommendation is to make sure you have 4 right cycles available. I have customers that do the 1 week out and then buy the 2 week out. It can be profitable, but you have to be right more often than wrong. And by this time, I'm meaning you have to be right 78 to 82% of the time to profit long term, because it's still leverage. And as we saw, with that tighter window on the first horizontal, you're only making 9%. It's about 28 cents. Okay, so if you take a loss in this short term, it just moves against you. You can have a significant loss in the position percentage-wise and wipe out 10, 12, 15 previous gains. So give yourself 4 right cycles. Give yourself more time to manage the position. One of the other reasons I mentioned I wanted to do this, 2 strikes apart, not only because I look for a specific delta in my diagonals and a specific delta ratio, other terms that you might not be familiar with if you've just been trading covered calls, is that if the stock doesn't do what I want and it pulls back to, say, 76 or 74, if I had traded the 75 call or bought the 75 call, that drop of 4 points or so down to 74 might cause this to lose 40 to 50% of its value. And selling the 75 call, I've now converted my diagonal into a horizontal to try to manage it, and that gets tricky. By buying the 70, if the stock falls to 74, this might only drop now 30%, 28% of its value, still significant. But with the stock at 74, I can still get a good premium by selling the 75 to help me manage this position and potentially turn it to a profit if I don't already have it. If I'm at the 75 and the stock falls to 74 or 72, the 75 makes it now a horizontal from when I wanted a diagonal, and if I try to sell the 72, you've actually now created a bearish calendar using calls instead of a bullish. So that's why you want this call to be a couple strikes in the money in that case. Now, this is for a short-term trade. This is for something that you think looks good for premium for a covered call. You don't want to spend the money, but you weren't planning on staying in it for more than 40 to 60 days. If you're looking at a stock that you plan on trading for an extended period, you want to mimic a covered call trade, you want to plan on trading it for an extended period, you're neutral to bullish on the position, almost like a core holding in your account, but you don't want to pay the money for it, higher price stock, Netflix, Amazon, something along those lines. In that case, that's when I'm buying a diagonal. And that's when I'm going at least 150 days or more out in time to have more right cycles against the position, to be able to have as many rights against it to maximize my profit on the neutral to bullish position. Okay, so I'm going at least 150 days out. Why? Because the time decay curve, something that we use as one of the 3 core principles of radioactive trading but applies to any trading, dictates that the time decay of an option, whether you're selling or buying, we want to be selling here. All right, so this is decay 30 days. It's very rapid. This is 60. This is 90. This is 120. This is 150. And this is 180. So if I buy farther out, even if the stock doesn't move and volatility remains the same, for almost the first 60 days, I'm not going to see a lot of time value decay. But I can be selling against it week by week, month by month, to lower the cost, even though I haven't seen any time value decay. But once you start to get within 90 days, 60 days, you don't have a lot of time before that slope becomes drastic. So if you're trying to play a stock long term, you like the premium, you're neutral to bullish on it, it might be a member of the core holding of your account or in your account in that case, then you're going at least 150 days out. But if it's a shorter term trade, you're only planning on being in for 20 to 30 days or so just to generate some income, give yourself the 4 right cycles minimum, depending on what you choose to sell. In either case, as I mentioned, there are reasons why I choose to look at the 14-day out, and then I give myself the 4 right cycles minimum against that. Okay? All right. Now, let's see here. So, step by step, let me pause the screen here and transfer back. And I'll just answer this the way I answered it in the email for you, Mark, to review on this one. But for everyone else, I apologize. We'll just review that. So, going to your questions, calendars generally, sideways market, some ranges for consideration. I mentioned that you can do whatever you want, but I prefer 4 right cycles minimum between the two. I usually start at 14 days out, and my long is probably going to be somewhere around the 60-day out time frame. You can do the 1 week out and buy the 2 weeks out. You can do the 1 week out and buy the 3 weeks out. It's just not what I prefer. I want more time to be able to manage, and I want to take advantage of the time value decay so I'm not right in the fast slope of time value decay on both options. Benefits of a horizontal: high return. Potential for a very high return. We saw that with a 63% on the horizontal on our example Celgene here. Okay, very high return. Small or low or limited upper and lower break-evens. Low window for profit. Okay, low window for profit. This is low upper for profit, but we've got a low window for profit. You want a stock that doesn't move. We talked about the ETFs. That's true, but the ETFs will have a smaller return. Dangers and cautions for adjusting. I find it harder to adjust a horizontal, personally. And maybe it's because I was trained classically with covered calls first and then other strategies. When we talk about a covered call, you just roll the call up or roll the call down. And in a diagonal, the call that I bought was usually 4 or 5 months, maybe more out in time, a couple strikes in the money so I can lower the strike of the call if I need to, or go up while I'm gaining on the long call. With the horizontal, we were talking about the 80 strike here. If the stock moves up and I start to enter this play, sure, I can convert it to a diagonal and roll the 80 short up to, say, the 82.5 or so, and my 80 is sitting here. But if I'm too close, I'm losing time value. I'm in that decay cycle, and I'm gaining intrinsic, but I'm not gaining time. Well, you never really gain time, but you're not getting any benefit of that there. It's starting to get a higher delta, but now you've converted to a diagonal, which might work. Okay? But sometimes investors will play both. So the stock moves up to 82. They want to keep moving the trade, so they'll roll both up to the 82.5. My long would be an 82.5, maybe out 60 days. And this is an 82.5 out 7 to 14 days. Okay, so we're both at the 82.5. What's going to happen with that, though? You've increased the debit. Okay, you had to pay more to buy to close the 80 call than you'll get for the 82.5, which is at the money. And you'll get a good amount back from the 80, but you're going to pay into at the money time premium for the 82.5. So usually what happens is the debit increases when you're rolling up a horizontal, which means your profit decreases. So you start out that high 63. If you roll up, that might lower to 43. Still potentially profitable, but how are you getting ahead? Okay, it's probably better just to convert this to a diagonal and let it ride up, and then maybe eventually take some profit out of this long if it keeps going as you expect. But again, that's not what you wanted. You didn't want it to go up. The horizontal is the definition of a neutral position you didn't want to move. Okay, so that's the dangers. And the cautions for adjusting, as I had mentioned, is that it's the same with any strategy or covered call. Okay, you don't want to have a short call open on earnings, in my opinion. I'm going to answer this to Rhajiv. Rhajiv made a comment here a moment ago. It says, short cycle horizontal good for earnings. Mike can check with Oracle. Earnings may be around the corner. And I can do that. But again, I don't want this. Rhajiv does this, but I don't want this position going into earnings with a tight upper and lower break even. When I'm hitting earnings, most of the time I'm expecting a stock to gap up 5, 6, 7% or potentially gap down 5, 6, 7%. As we saw that first horizontal, even if you have a dud earnings and it only moves up 3%, you're beyond the upper break even and the lower break even. Rhajiv's idea is to go really short term around earnings, have a very low cost base, and if it gaps up, roll the call and keep the long. Well, if it gaps up 10%, I'm paying way too much to buy to close this long, and I'm only going to get 50 cents or $1 to roll up to the next strike, from 80 to 90 in this case. That doesn't help my position. My debit's now around $12 for a horizontal spread where I probably wanted a low debit of only 2 or 3. Okay, that's why I don't like doing that around earnings. But Rhajiv has done it, and we've had conversations in the past during our open forums. The dangers of rolling down if it moves against you, you say, oh, well, it's losing. My 80 call is losing. The stock fell 5%. My 80 call is down almost 25 to 30%. I need to manage it. So the stock dropped from 78 down to, let's say, 75. Let me sell the 77. Well, now you're actually in a bearish diagonal using calls, what would more look like a calendar put spread. And if it gaps back up, you're going to have a much larger loss to the upside. Those are just like with anything else. With adjusting a covered call, if it moves down, you roll the call down, then it snaps back up. It's the same thing. Okay? Timing is important. Structure is important. But again, this is why I prefer the diagonals over the horizontals and personally don't trade them. Why to consider? Why would I consider a diagonal spread as we looked at, buying the 70, selling the 80 instead of the 80-80? And the reasons for me for that is it's a leverage. It's just like a covered call. It's still neutral to bullish strategy, but it's more conservative compared to a horizontal. Why? Because you have a higher delta on the long that's mimicking stock ownership, and it's gaining a higher delta ratio against the short option as the stock moves up. So if the stock moves up 1 point, the delta of my long might move from 0.7 to 0.8, whereas my short may have just moved from 0.5 to 0.55. I still gained 50 delta, 0.05 delta here, but I gained delta of 0.10 versus losing a delta of 0.5. Okay? In the horizontal, they're almost equal. Right? So this is mimicking stock ownership. It's more conservative in a neutral, if you do have a neutral to bullish stock. I find it's more flexible because I have that 70 call and I sold the 80. So if the stock falls, I can sell the 75 and still be in a neutral to bullish position as I originally was. Okay? If it falls to 74, with the horizontal, I have to adjust both, or I run the risk of converting it to a bearish trade and hoping it stays bearish at that point. If the stock moves up, I gain more positively on the long call because of the higher delta. Ranges and time to consider are exactly the same, whether you do a horizontal or diagonal. I go 14 days out for the first right cycle when I'm doing it, and I want at least minimum 4 times, maybe 5 times the right cycles. Benefits, a little bit more conservative, as I mentioned, and remember, the horizontal, you're doing an at-the-money option with a delta of about 0.5. So if the stock falls, even if you're 60 days out, 28 days out, if the stock falls 5%, this at-the-money option, what you're actually invested in, is probably going to drop down as much as 20%. But if I'm with the 70 in the money on a diagonal and the stock falls 5%, this might only lose 9%, 10%, maybe 12%, but not 20%. And if it drops 10%, sure, I still might lose 30% on the leap, or I'm not a leap, in the money, but this is probably going to be down 50, 60, 70%. Okay? Game of deltas, game of delta ratios, something different than you've probably been looking for with covered calls or standard straight strategies. All right. Cautions and dangers and difficulties in adjusting. Now, it's the main caution to keep in mind. Is this strategy better? Let's see, make sure the screen comes up. Is this strategy better than doing a covered call? Is my return better here, buying that July 70 call for 963 and selling a June 80 call for 106, 14 days out, return of 24%, better than buying the stock at 78.37 and selling the June 80 call for 106? Well, yeah, I mean, it's 24% versus maybe a 3% return, a 2% return. That's obvious. But leverage works both ways. Okay? Stock's at 78.37. What happens if it drops 7 points? Let's call it 8 points, just about 10%, 11%. It drops 8 points and is trading right at 70 on expiration. Wow. See, even in the money one, this actually dropped about 60%. 60% of its value. Okay? What are the dangers and the cautions? Declines. Leverage works both ways. Why this is essential is this is a 60% loss. You paid $962 for it. If the stock falls to 70, 10% in the first 2 weeks, you're down to $329 value. Expected value of that option. You've lost $633, 66% of what you paid into the position. So if you get this full 24%, at least that only wiped out 3 previous trades. But if you're over trading because you wanted to use leverage, where you said, well, I have $7,000 to invest, or I have $8,000 to invest, so if I did a covered call, I can only buy 100 shares and sell one call against it. But here it's only 856. You say, oh, I can do 10 contracts. Now let's say at 9,000. I could do 10 contracts and only have a cost basis of 8,500. Then you've lost 66% of that 8,500 you invested in the position. Okay? It's going to wipe out a lot of trades, just the same as vertical spreads. Calendars are no different. The leverage is a benefit. The leverage is also a caution. You can't overtrade. You have to be disciplined. Any vertical spread or diagonal spread that you trade should only represent the maximum risk, assuming 100% loss, which you have to assume because things can just completely go against you from time to time and will. Not every month, not every 2 months, maybe not even every 6 months. Once a year, twice a year, 3 times every 2 years, you'll hit a position that nears that 100% loss from an unexpected event that you couldn't see on the chart, in the news, any diagram you looked at, any charting software you look at. Something just can happen. So this should not represent the monetary risk, the debit for any calendar spread, horizontal or diagonal, or any vertical spread, credit spread or debit spread, should probably not represent more than 2 to 3% of your total portfolio value. Otherwise, you're risking too much into one trade. Okay, that is a concern. Now, let's take a look at our horizontal real quick. Here's a devastating 60% loss with a 10% decline, and that's on our diagonal. Let's take our horizontal. We were near term. Oh, we did the 14 days, so we got to do the 63-day out July. 80 call at 320. There's our horizontal once again. 61.9% return. Good upper and lower break even, better than the 1 week out, which is another reason why I go 14 days out instead of 1 week out in time. And the stock drops that 10%, roughly $8, a little bit more than 10%. Wow. 43 cents. You paid $3.22 into it. Yes, you only had a debit of $2.66, but you're at a loss of $1.73 on an investment of $2.16. What does that come out to percentage-wise? Is it 72? Let's see here. So I'm sorry, what did I say? It was a loss of 173 off of an investment of 219. 216. All right. So that's an 80% loss for an unexpected 10% decline. Do we see it that often? No, but remember, this is just the numbers. So 10%, we would have a 60% loss. Now, one more comparison while we're here. Long-term bullish on Celgene. I'm not. This is an example. I buy the 70 call out to October, at least 5 months out in time. Cost is high, 1170. First right cycle, get 106. About 10% against it, only 17% return. And this one, because the higher cost does give me a second way to lose, but it's all the way out to 96. All right? This is favorable for what I'd look for a diagonal, return-wise. Debit, though, is not less than my difference in strike, so I would never trade this personally. But let's do the comparison once more. In this case, with the longer term, stock drops to 70, June 1st expiration. We only lose about 50%. Okay, so the further you go out in time, the lower the loss of leverage. Because you have more time, the time decay is more slow, even though the intrinsic value was lost. Okay, but that is the main danger, the main caution. Leverage works both ways. I cannot illustrate that enough. Too many investors get caught with diagonals and horizontals. Overtrading the position because of leverage, the stock falls 7 to 8% unexpectedly, and now they're at a 60 to 50% loss of what they invested into the spread. They just wiped out 5 to 6 previous trades, and they can still lose more if it continues to go down. That's where the management comes in, but it's very hard to manage a position to a profit if you only have 2 or 3 weeks to expiration to go if you have a 50 or 60% loss on the position. Okay, so cautions are leverage. 5% in a drop could result, we saw, as you know, a 30 to 40% decline. A 10% drop could be a 50 to 80% loss. And as with any strategy, the difficulties come within timing and market conditions. So if I needed to manage this by rolling it up, it goes to 82, I roll to the 85, and then the stock pulls back to 74. I would have increased my cost basis here because it would have cost more to buy back the 80 call than what I would have received for rolling up to the 72. My cost basis might have gone up to 11 or 12, and then the stock snaps back. Okay, sure, that call will expire and I can keep trading it. If I'm in a horizontal, if I'm in a diagonal, if I'm in a horizontal, it becomes more tricky. Okay, so that's sort of where I was going with this. That's what I sort of want to review with the diagonals and the horizontals from Mark, best as I can. It took more time than I wanted to, but that's okay. Covered a lot of good material there, but remember, more slowly presented, more full discussion. powerop.com/webinars.asp under Option Strategies. Calendar basics, definitions of horizontal, diagonals, proper structures, specifics to look for, what to avoid, and more. And then the criteria, not just the underlying security for a diagonal or a horizontal. Mark, I agree with you. You probably want an ETF or something for the horizontal simply because it is less movement. Now, that's one comparison I forgot to mention, but you can go to the webinars page, get more information there. Also, the past couple weeks, first two discussions we had were defining calendar spreads, poor man's covered call, early assignment on diagonals. We started that as well. There's some other discussions in here on diagonals further down in time. I just don't know where they are. But these are the full presentations. Calendar spread basics and criteria, comparing what we looked at earlier. All right. One last thing I want to do on this, then we'll move on to the other questions that came in. Let's go back. We spent a lot of time on horizontals, at the money horizontal. We looked at the June 1st versus July 20th series, I believe it was, with a 61% return on Celgene. I keep saying Oracle, but it was Celgene. Let's go to SPY. Same example. Now, these have the Monday and Wednesday expirations. I'm still focusing on the Fridays. June 1st, 14 days out. Scroll through all that. Versus our standard July 20th, 63 days out. Oh, sorry, folks. There we go. Okay, so we're going to use the at the money 272. We use the at the money 80. Let's go 273. We used the at the money 80 on a stock that was trading at 78. So we're going to do a horizontal with the 273 strikes for SPY right now. I'm going to sell the June, buy the July. It's at 271.33. So this one's good. So 54.8. Upper and lower break even are just $2 down and $5 up. And that's for a 2-week trade. If we did the 1-week trade, remember that would be much smaller window to profitability. So this time we're hoping that it stays right between 276 and 269. Is it more likely that SPY would stay in this range than Oracle would stay in that first range we saw of 77 to 79? Probably, okay? But it's still a tight window. Still a 54% return based on Black-Scholes models, assuming the implied volatilities sort of stay the same for this July call and this June call. But remember, the max, that 54 is only right at 273. You're still profitable in this range, but here, even if it goes up an extra point from your main, it drops up to maybe 272 or 274 or 275. You're only at 73. You're at half that profit, which is 25% of the 259 in. Still be pretty good, but that's a tighter window to 50% profit, isn't it? More likely SPY would stay there than a standard stock, but it all depends on market conditions. Who says what on the geopolitical theater? Who says what on the U.S. theater? And at what time? Market swing down, market swing up, you're at a quick loss. Okay. Okay, this is a question from Rhajiv, a question from earlier from Rhajiv. We're going to move on to the next questions now. I'll look at the topics in a moment. Rhajiv asked a question relating, I think this has a name. He said he's looking for a combination of a bear call and a naked put. Not something I trade by any stretch of the imagination. I don't like this particular strategy by itself. You get good premium. We'll just stick with Celgene since we've been watching it for most of the time. But let's say let's see here. He's all right. So for about 45 to 60 days out. So let's just go to 42 days out, the June 29th expiration. Let's go with a bear call, 78. Yeah, I'm probably going to go into 82.50, 85 bear call in this case. And it's only about 40-cent net credit for a 2.5 spread, but that's pretty reasonable. And he's selling an out-of-the-money naked put. These premiums are high because earnings is probably coming up between now and expiration. But in any case, the bear call spread with a naked put. Now, what is this? This is like an iron condor without the extra leg. Okay, and so I think what Rhajiv is trying to do, he's trying to set up what he would as an iron condor, but increase the premium by not buying the outside leg, figuring that, well, if it does fall below 75, and in this case I'm sure he'd probably go down to 72 or 70, but if it does fall below 75, he may be okay buying the stock at 75 because he took 233 premium in, so his cost basis would only be 73. But his question is, I'm looking for another one to buy to complete the condor if it's pretty cheap. So what I think he's expecting is the stock to actually move up or time to pass after 15 to 20 days so he can buy this 72.5 or 70 put more cheaply and still maybe keep $2 or $1.90 of the 233 net credit he originally received. Okay, why don't I like this? Is that you're setting up sort of a bear call spread, assuming the stock is neutral or bearish, but then you take on this extra risk to the downside. Well, what he's really doing, I think, is entering a naked put on a stock he wouldn't mind owning, then trying to increase the return by doing a bear call spread. The margin requirement on this is significant because you don't have the extra put yet. You're putting up a lot of capital here to do this trade. And to have it on hold, hoping that if it does stay within this range, then all three legs expire worthless. You never needed the extra leg. To tell you the truth, Rhajiv, to follow up with the rest of your question, I'm looking for another leg to put to convert to the iron condor with zero loss on either side. Now that, unless you've structured it really close, that's never going to happen. I mean, you have a small risk here, I get that, but when you add it in, it's going to increase the risk on this side and increase it here. It's not going to lower the risk when you buy the new put. Whether you get a cheap price for it or not, it's still adding to the cost, which would add to the risk on this side or this side. I don't have a tool that will do this for you. I don't have a tool that will find, number one, these kind of positions, this kind of combination, and I don't have a tool that will show you how to manage it where you can get the put at the cheapest. Now, if the stock moves up as you expect, you may be able to buy a higher strike put. You may be able to buy, let's say, a 77.50 for a cheaper price. That might do it. But again, it's a tough, I don't like this trade specifically, and if it's working out for you, that's fantastic. I don't like this because the margin requirement is still a naked put. No part of this bear call covers that obligation of selling that one contract. And so look, it's only a 3% return. You might get the same of doing a covered combination, or why not just buy the 70 put right away to complete the iron condor? And then you have a leveraged 15, 20, 25% return. But let's say the stock moved up as you wanted to, Rhajiv, 10 to 14 days into the trade, 15 days in the trade. And let's say you can buy that 77.50 put for only 80 cents. Well, the stock would have to be moving quickly. It'd probably have to be above both strike prices. I'm sorry, 80 cents. Now, if it's a higher strike put, this might work. But not really. See, it's still, wow. We're just complicating things, aren't we? We've got sort of this ziggurat step stool type profit and loss chart with the risk increasing over here to 112 now compared to where it was at the beginning. So that's very difficult. You've created a bear put debit now with a bear call. You're double bearish. But if you buy a lower one, it's still going to add to the cost where the risk on the bear call is going to be increased. Once you're in this structure, anything else that you buy will increase this risk, not lower it. It won't bulletproof it. It won't cancel all the risk in that scenario. Okay. All right. Is this, all right. Martin's question is next. Okay, this is going to be hard to follow. Actually, I think I'm going to take, Martin actually looks like left. He might have come back in. He might have been disconnected. But I saw another question, at least two other questions that came in. And that's not it. Sorry, folks. There it is. Okay, sorry, Randy. I think I already covered this. I'm not sure. You said you mentioned going 150 days out. When do you do that? Okay. Randy, you've heard me talk about the radioactive trades and the married put before. And I talked about when I'm buying a leap, you can buy a leap call. That's a common strategy. Buying a leap more than 150 days out, maybe as much as a year out in time in some cases. There's nothing wrong with that for a diagonal, but it's not a short-term trade. It's longer term. You're planning on 5 or 6 months of right cycles if I bought a January 2020 leap right now, minimum. It's a longer-term trade. It's a longer-term play that I'm really neutral or bullish on. I feel really strongly about the direction of the stock and the strength of the stock, and I'm using it to mimic a covered call or core holding in my account. That's when I'm buying the option, the call option for the diagonal at least 150 days out in time. If you just want, you're not comfortable with doing a bull put or a bull call debit, but you like the stock and you think it's a near short-term trade, that's when I always make sure I have at least the 4 right cycles minimum, but I may go farther. In general, my diagonal spreads, I'm pretty much out 120 to 150 days on all of them. I don't trade these tight windows of weeklies. Okay, I may sell the 14-day out against it, but I'm not buying a 1 month out and selling the 5-day out against it. To tell you the truth, and everything I've tried from 4 years ago to 3 years ago to last year was more profitable, but I've never been profitable trying to develop a new strategy of buying a 4-week out, 5-week out call and just selling every 5 days against it. Too little premium in the weeklies against the option that I bought, too much movement, even in that neutral to bullish market where we were lower left to upper right, too much movement during the week that caused too many triggers to roll the short. I'd rather go out 14 days, get the higher premium on the position, keep my right cycles at 4 times. You've heard me say before that I can't trade, based on my account size, Randy, I can't trade Amazon, Netflix, other positions along those lines because my account dictates that I shouldn't do that. I can't do that. But in general, I look for married puts, longer term hold positions with very conservative limited risk, still with 50 to 60% of my trading capital. Those puts, of course, are 5 to 6 months out or time or more. My average is about 8 months out. But I don't have the capital to buy Amazon, so I will trade it as a calendar. And in those cases, I'm usually buying 3 to 4 months out. I haven't done Amazon in a while, but Netflix, Apple even. I'm not doing it as a married put, but I'll do it as a calendar, a diagonal. I'm buying the in the money, but I'll use the 150 out because of, and I'm pretty sure you saw it, but we'll review it again, I want the time value decay in my favor. I don't want to buy 60 days out, and after the first right cycle of 14 days, I'm into this where my long option is starting to decay more and more. I'd rather be at the 120, 150 mark, so after the first 30 to 60 days, I haven't really started to hit that time value decay on the option. Okay. Okay, Ben, I'm not sure if I understand your statement here, and it's just because we were talking related to one of the strategies we were looking at with Celgene, with the diagonals or more. But okay, I see what you're saying. Okay, Ben says, I strongly believe you have the best chance to win when the VIX shoots up and then go long. Well, the idea is when the VIX collapses, okay, is because the market fell, so you're trying to bottom feed. Okay, you're looking for buying opportunities. And you'd be right, but in certain markets that can also be tricky. Okay, would have worked out for you now if you had the constitution to hold. What do I mean by that? Let's take a look at the 3 or 4 month chart of the VIX. Okay, everyone had some fun here. I had some fun because I had bought VIX calls in mid-January. When this spike happened, I closed them out. I think it was for an 800% profit. And then here, but then it spiked up again. So was this a good time to go long after it settled here? And let's say this was February 5th through 9th. This was that volatility craze recently. And, you know, was this a good time to buy in because it was low? around February 20th, February 15th? It was. The market went slightly up again here, but then this was the March 20th to April 5th spike. What was that from? That was the tariff discussion, the fear of a trade war with China. So in this case, any stock you bought here after the spike occurred and the VIX started to drop down here, yes, we went up, but then we came right back down. So you would have hit triggers to get out here. And then we had that other spike back up to 25 here. Oh, I'm sorry, this is March 5th. This was a little sub glitch here. This was the March 20th to April 5th. I'm sorry, this one here. So buying here at the low, we had another dip, but then it did settle, and it was going up this direction. But then here, everything fell again. Here we saw stocks drop 11, 12%. Here was about 7 or 8%. But yes, then it started to come back, and we've been going up again. Okay, so this was a good time to buy. This was potentially not a good time to buy. Okay, if you held through the second decline. Okay, now you're right. Why is the VIX high? It's usually because the stocks fell, because some fear, some event, fear in the market, and so forth. You say then sell a bull put spread on any great stocks. Well, yeah, but you got to pick the great stocks. And remember, we're in earnings season too. So in addition to the stocks fluctuating at this point, you're buying here on the lows when the markets were low, going here, but now we're hitting into an earnings period. So the stocks that you're in are selling bull puts. You want to avoid selling vertical spreads on stocks that have earnings during this time frame, even if the VIX is high, because the earnings can trigger it one way or the other. So, you know, it's a common way of bottom feeding, and you're right. What I did is I managed the positions I owned in here during this spike. I didn't buy anything new here, except for when it dropped down here, I bought more VIX calls. But then at this point, I started buying new married puts. This went through, I managed my losers. I've opened 2 married puts since then. One is up 15% and one is up 8%. Strike that. I'm sorry. One is up 15%. One was up 7% here, but is now up only 1% because it pulled back recently. Okay. All right. So, yeah, and you say close to when the VIX hits the bottom. Well, sometimes that's hard to gauge. You know, this wasn't the bottom here, was it? Nope, came right back up. This wasn't really the bottom here. Came right back up. Are we at the bottom now? I don't know. Someone can open their mouth over the weekend. We could be right back up here. It's a possibility. True possibility. Okay? All right. So, Binh, your comment is correct. Your theory is correct, and your practice is probably correct. And it's just like when I entered Interactive Brokers 3 months ago as a married put trade. One of our Fusion subscribers. So what you're saying is, you pick the bottom of the VIX. You want to buy when the VIX is at the, picks it when the VIX is at the top, so the market's at the bottom, and that's the time to go long. And you're right. Timing is right and everything else. Now, I had a customer, when I entered the Interactive Brokers Radioactive Trade at Fusion, I got in a position when the stock was at about 68, 69, right here, end of February. Okay, it's gone up to 80 just in the last 2 or 3 months. There's hiccups in between. But the customer said to me, of course, when I bought in here at 69, he said, why are you buying at the 52-week high? This is where you should be selling. And it's probably what he said when the stock was at 60, and the stock was at 55, and the stock was at, here. The risk, some of the risk was trying to bottom feed. Now, sure, I would have loved to buy it at 60, you're right. I've loved to buy back in here. I adjusted the married put, I didn't buy, but I would love to buy back in here at 62 or 63 and went back up to 80. The problem with this is that the 52-week high is only as high as the next 52-week high. And if you didn't trade Interactive Brokers back in September, and I didn't either, don't get me wrong, it didn't come up on my search screen, but if I didn't get it at 38 or it didn't get it at 40, but if I didn't buy here at 40 because it's at its 52-week high and that's something that's going to fall in price, you missed 100% return. Okay? And I'm only bringing that up is because when there's a VIX spike, you're right, that's more market-wide, Binh. That's more a market-wide fear, and the markets will drop. Here, down to 60, perfect buy opportunity again. And here, again, where I just said 62, perfect buy opportunity again. You're absolutely right. Some stocks have not recovered from this. Some industries have not recovered from this. AMAT is one that I traded last year. You might remember we were talking about that September and October of last year. And I was trading it between 55 and about 62. It was just staying in this weird range. And then once it dropped down to 54, another time I think it went up to almost 64. I saw it today. It was about at 47 or 48. Okay, so it hasn't recovered. It kept dropping and dropping. The semiconductors all related to China. So after the volatility spiked out, the fear of the tariffs, well, the semiconductors still took a relative hit on that position. And then the earnings really had the major effect on it today. But it continued to go down. It never recovered from these two. And there are other stocks that have never recovered. So yeah, you're right, though. I agree with you. Ernie and I do look for them at buy opportunities as well on the strong stocks, on the stocks that were still leaders in their sectors and industries, on the stocks that were still performing well, positive earnings, and have everything as well. And don't be greedy. You're absolutely right. Don't be greedy. Sometimes I am, but yeah, don't look a gift horse in the mouth. I'm very happy with this trade. I'm still very happy with this trade, and I just adjusted it today again. But you're right. That's the key, Binh, is that those are good opportunities you mentioned. And I don't know if you were here a few weeks ago. It's interesting when we looked at this, let's convert over to a 3-month or 6-month chart real quick. And let's go to 3 years actually first. And it shows better because it condenses in the 3-year too. Our little volatility hiccup, February 5th through 9th here. Not so much the one in March and April, but this one here. We had not seen this pattern, this type of up, down pattern until really back in here in 2016, beginning of 2016, a little bit towards the beginning of 2017. But really, it's been about 2 years since we saw this kind of pattern that we're looking at, that we saw here, where it really viked up and really came back down. Sure, there are volatilities in there, but you look at it, for pretty much the next 2 years, we were lower left to upper right, almost couldn't miss on anything unless you traded GE. Okay? And, you know, that's the key. But this little blip here was very interesting, because is it a promise that we're going to see the next thing coming out of this one when the last time we saw it was about 2 years ago? Not going to guarantee that. Not going to guarantee that at all. It's just very interesting. We hadn't seen that pattern for some time, that type of volatility shift and adjustment for some time. And then we had it happen again, which was another warning sign, wasn't it? That looked kind of creepy. It's still kind of nerve-wracking. There's still things going out globally that could have an effect. And last but not least here, we'll do NFLX. Binh, for your recommendation, suggestion, but let's go back to that 3 to 6 month chart, shall we? There we go. Yeah, see, so this one, on our cycle of February 5th to 9th, it just had earnings or some news, and it popped it up and pushed it up, but then that happened. So you dropped about 280 back down to 240. And then, you're right, perfect strength stock went back up. Interactive Brokers, a good strength stock, went back up. Then your VIX spike here, March 20th to April 5th, we dropped back down from almost 340, almost 330, back down to 280. And then we came back down here a little bit, and now we're sort of trudging water, okay? Don't know what the future holds for it, but that's where it is now. And you're absolutely right. Interactive Brokers, you saw, was a key to that too. Would have been great buying points after the volatility spiked. Goose, GOOS, is the one I'm in that I've been in for, I don't know, 12 to 15 days. That's up 15%. That one I did buy close to the end of this. It's only, or I'm sorry, this last May little decline that happened. I bought in shortly after that. It was a very strong stock and still going strong. Not positive it's going to continue. It's a very strong stock. Okay. So let's see here. We've only got, we're about 15 minutes over. So if anyone has any other last minute questions, go ahead and send those in. Oh, Rhajiv says, AMAT, after earning, any further update on radioactive position you hold? I closed AMAT months ago. I'm not in AMAT anymore. I closed that about 2 months ago. Took the profit off the table, didn't continue trading. It was still bouncing around that 55, 54, 53 range. I decided just to get out of it at that time and not continue the trade. Took my profit on the position and moved on. Wasn't in the position through earnings. Haven't been on that one as well. All right. Now, this is something I don't know if anyone follows or if anyone tracks. Martin asked this question. I don't know if he was able to come back in and join us. I don't think he was. This was the one I was getting to, but I was having some trouble reading it. And now I think I've got a better grasp on it. But here is his comment or question. And he says, of course, here's a question if you have time to answer it. Sorry, folks. Thinkorswim indicated a flash trade today. Apple was trading at about... oh, shoot, should have gone back. Let's just go back to the chart there. Anyway, let me go back to the chart first for Apple. We'll cut it down to a daily chart. Or maybe let's go to sorry, folks. Let's go to a 3-day chart. Oh, 2 days is fine. Okay, sorry about that. We'll go 5-minute. Okay, so anyway. And he says that Apple... TOS indicated a flash trade. Apple was trading at about 186 at 8:10 this morning. Okay, so for the market open, you see some volume spikes here towards the end. It says it was trading at about 8:10. Oh, I'm sorry, it was 186 at 8:10 this morning. So right around the market open, it popped up to about 186 or so. That's probably this line right here, somewhere in here. Okay. All right, now. Someone sold 21,000 June 18 150 calls, which are off the map. All right, so they sold 21,000 June. I don't know if this is standard or weekly. 150 calls on Apple for 37.05. Okay, so that'd be 187.05 roughly, right? 37.05 there. Okay, so the 186, we're looking at about $1.05 intrinsic, or time value. And then they bought November 165 calls for 26.65. Ugh. The November calls cost 191.61. The sold calls 187.50 with no time value. Bearish trade, but I don't get the logic. Okay. Let's look at it on the graph again now that we've seen it. So this 21,000, I guess, were both. 21,000 contracts of both. TOS says it was a flash trade. Thank you, Mike. Let's enter a symbol. All right. So I'm assuming, again, June standard, 150 calls, 37.50. We're not going to sell 21,000. Okay, let's just put in 20, whatever. All right, and November 165 calls bought. So this is going to create a bear, almost similar to a bear call spread. Okay, and they bought those at, you gave it 26.65. I guess it's the same size. All right. Now this does create a bearish position. It's almost a bearish position. We wouldn't think there's any profit here. Now with 21,000 contracts, of course, it's still at a credit. The risk is only 8,300. It's going to be this 15 difference in strike prices minus the credit that was received, which was around $11. Okay, so that's the maximum risk. So maybe they are heavy bearish, and maybe they're heavy bearish heading into earnings or something. What we don't know is who did this. Was it an institution who owns 210,000 shares of Apple? Why would that be different? Well, let's do it. Let's add the stock. And instead of course, 20 contracts, let's add in 2,000 shares. Cost base around 185. We don't know. Their cost basis could have been 140 or 150. We don't know. Let's put 175 in. So now what have they got? They've got a covered call position with a long call. Okay, unlimited upside. They hedge some of the costs of the position. They still could lose now if there's a massive pullback. But what if their cost basis was 147 and they sold the 150 call? I mean, the break even doesn't hit till 135.23. Okay, there's no way of knowing. This could have been done to manage a position. This could have been done to actually protect a different position. This might have been done to protect a naked put position, almost to create sort of an in-the-money short strangle, which again I wouldn't do, but still has the view. Earnings coming up on 7/31. How does that play into this? Well, the June call is going to come up to expiration before then, so maybe they are playing a bearish trade, or maybe they're hoping to get assigned, but then they've got that November long call they can treat as a calendar. Martin, I don't know. The flash trade occurred. By itself is a bearish position. What we don't know on the other side is, did this person have 15,000 calls at a different strike price? Did they maybe do this to complete a butterfly of some kind, or an iron, or an all-call condor perhaps? Or if they had bull put spreads, maybe they completed some kind of calendar condor with this. Or if they own stock at a lowest cost basis, they're still going to get a strong profit if they allow themselves to be assigned at 150, and now they've essentially received this call to use as a diagonal further after June expiration for nothing. It's free. That's what we don't know. By itself, you're right, it's bearish, but the risk of evaluating a flash trade or something that comes across when there's all of a sudden 1,000, 2,000, 8,000, 15,000, 20,000 calls or puts bought or sold at a certain strike is you don't know who's doing it and what else they have in the background. A year ago, they could have bought 21,000 May 18 130 calls, or sold 21,165 calls. We don't know. Okay, we don't know what is behind the rest of that, and that's the tricky part. Yes, it's interesting that it was all done at once. Yes, it's interesting it's all done together. Looking at it by yourself, you're absolutely right. It would be a bearish position. Their target would be the stock to be trading at 150, but even here, they're at a profit at 165. Anywhere below here, and their risk isn't that high comparatively. And this, remember, this view was only with 20 contracts, not 21,000. The max profit is 29,000. The max risk is only 8,300, and they took in a credit of 21,700 up front for 20 contracts, not 20,000. Okay. What game are they playing? We don't know. We can look at this and say, why would anyone do this? And they may have their reasons. We can see kind of the lower-ish risk comparative to the potential return on some big bet. I don't know, but we don't know what they have in the background. This could just be a covered call with buying long calls further out in time to treat as a calendar after they get assigned at June expiration. If they own 210,000, well, 2 million shares, right? Yeah, 2 million shares of Apple, 2,100,000 shares of Apple to trade the 21,000 contracts against. Could just be an in-the-money covered call, paying for a leap call as well, even if they get assigned. If their cost basis was low enough on those 2 million shares, 140, 150, 130, well, this is a brilliant trade, right? This is a very strong trade because you get this long call for free after you get assigned here, hopefully ignoring any tax consequences. But now you've got a leap call that you receive for free, and you continue to trade it without that 2 million shares invested. I don't know if that's it. It could be any combination of anything that we don't know. But you're looking at it right, Martin, when you see it, okay, you analyze the trade, you did that, you said, what is this person doing? Only they know. How could the rest of the market have benefited from this? I don't know. Okay. Did it cause the stock to move, to jump, seeing 21,000 contracts traded for a June short call, 21,000 contracts traded for a November long call? Doesn't look like it, did it? Didn't really have an effect on that too much. Okay. So we'll have to see going forward, and we'll have to see if any of those contracts, large blocks of them, start to get closed or adjusted in the next few days. But you're right, Martin. That's what they're looking at. Why would someone do this? We sort of discussed that. But in reality, it's probably part of a larger trade that we're not privy to that could have been done months ago, years ago. Not with the options, but maybe with the stock. But yes, there could be a whole slew of other options in here on this position. A fund manager, hedge fund manager, maybe owns lots of shares of stock for his clients and decided, you know what, we've had our run. We've run it up from 135 to 186. Rather than take it off the table, let's earn an extra $1 and sell those 150 calls for $37.50. And then it does get confused by the November 165s, but again, could just be to get back into the trade, could be to treat it as a leap, could be a part of a much larger trade that I'm not even conceiving of right now. That's always the possibility. All right. Well, ladies and gentlemen, it looks like that's all the questions we had. We did spend a lot of time today on the diagonal spreads for Mark. Maybe, oh, sorry, folks, maybe it was a little bit confusing, but that's why we tried to spend the time there to go through the different definitions of what is a calendar, what is a horizontal, and what is a diagonal. Both horizontals and diagonals are calendars again. And just the horizontal is the same strike, diagonal is different strikes. And of course, what I didn't show today is the reverse diagonal, where I'm buying an out of the money call that's a few months out in time and selling near term at the money against it for a cheaper cost. That again is creating a bearish position, not a bullish. And it's usually done in double diagonal format, not for a single trade. Okay. But so that's why we broke those definitions down. And remember, you can see the full webinars at any time, powerup.com/webinars.asp, as we showed there. You can take a look at that at any time to see the full presentations on the calendar spread discussion, calendar spread criteria. All right. Now remember, ladies and gentlemen, today's material just my thoughts on your questions, designed for educational purposes to increase investing performance and options knowledge. Any stocks or options discussed today, Celgene, of course, we talked about Oracle, Rhajiv had mentioned looking at that. We just took a look at the Apple spread there. These are not recommendations or suggestions. We talked about theory of trading with buying when the VIX spikes and starts to recover there. When we see the VIX spikes, those are usually good buying opportunities, but it does involve risk in case things continue to go that direction. All right, but no direct stocks here. Spreads that were shown, adjustments that were shown, not recommendations or suggestions. Remember, options involve risk. And reminder, markets will be closed on Monday, February 19th. They already were. They'll be closed next year around Monday, February 19th, 20th, or 21st. I forgot to update this slide. Not closed again until the end of May. So we still got a full week, I believe, next week for the markets. Yeah, I think next week is a full trading week. All right. So we didn't spend much time looking at the search tools today. We showed a little bit on the calendar spreads. We didn't look at the portfolios or talk about radioactive trading. But again, if you haven't checked out Power Options, oh, it is the 28th. Thank you, Clement. So it mentions it's closed on the 28th, so it's the following Monday. That's right. But if you haven't tested Power Options yet, simply go to powerup.com. You just have to put in your name and email address and click Start My Trial Now. No billing information is required. You can test out all of the tools, the portfolio tools, and more completely free for 14 days. Now, after that, our subscription levels start at $40 per month. That's for the end-of-day service, where the data is only updated at the end of the day. Our most popular service, of course, is the delayed service, 15 to 20-minute delayed data, access to all of the searches in the various 23-plus strategies we support, access to the picks of the day as well. You just don't have real-time data or access to the historical. And that's only $60 per month. But you do have a subscription for real-time here and the 20-minute delayed plus full access to our historical database, which goes back to April of 2006, so over 10 years of options data at the close as well. It's very affordable for options traders and options investors with all of the tools we have for analyzing, finding, save time finding trades, let alone analyzing, tracking, and managing your positions as well. Other free stuff, remember, you can check out our blog at any time. We referenced the webinars page today. There's a variety of presentations in there related to all things options, basic options, options concepts, the specific strategy discussions, as well as our archive of all of our Friday discussions in the requested topics category. Remember, you can always catch us on YouTube as well. These presentations are public. We also put up some short 2 to 3 minute videos from time to time there on, the 7 ways to manage a bear call spread and which covered call is the best strike price and more. You can always check us out on YouTube. All right, well, if you think of any questions later on, whether it's over the weekend or just any time, remember, go ahead and send me an email at any time to support@powerup.com or to support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And remember, those of you that are currently on a trial or are subscribers to Power Options, you can schedule one of those free sessions at any time. Just click the free coaching link underneath the main home tab on the Power Options tools, and then you can select the time that matches your convenience to have essentially a 35 to 45-minute phone conversation with myself or Ernie. Once again, thank you for your questions. Thank you for joining me this afternoon. Everyone have a fantastic weekend. We look forward to seeing you next week as we wrap up May 2018 and get started looking into June of 2018, continuing on with the year and jumping into the heart of summer here for 2018 trading. Take care, everyone. Good night. We'll see you soon.